So I really appreciate you guys logging in to this webinar. We're going to be talking about investing in real estate outside of your area during the COVID-19 virtual economy. And I put that down there as the virtual economy, not necessarily the pandemic. I think after, kind of coming out of this pandemic, things may be a little bit different. The way we look at stuff, the way we operate, I believe it'll be a lot more virtual, a lot more virtual. And so it's just going to be an important thing for us to do is to make sure that we are, set up to operate virtually. And I think that here is, investing in the real estate is another great way to, do business virtually. And as we've been down last couple months as a real estate investment company, as a brokerage company, we've been doing everything virtually. And so I've done a presentation several times about investing out of state, out of area. Just in times past when I got started in real estate, really my first deal was in Pueblo, Colorado. I lived in California. So I got a lot of experience investing out of state, but I think things are changing. And I think now, that's why I called it during the COVID-19 virtual economy. And I think we'll be more in a virtual economy going forward. So a few more people are tapping in, but we're gonna get this thing going. And I'm gonna keep the time to an hour because I believe everybody has a lot of Zoom meetings. I don't know about y'all, but I've been Zoomed out over the last few weeks, but this is the new reality, right? And so I don't want to Zoom y'all out on this one. I'm gonna make sure we break it an hour, and I'm gonna go with the presentation for about 50 minutes. I'd ask for you, if you have some questions, chat them in, but I'm gonna be kind of dialed into the presentation. At the end of the presentation though, I'm gonna come back to the chat and the questions and review all of the questions I can get to within 10 minutes and make sure I'm responding to you guys. So with that being said, again, welcome. My name is Steve Peterson. Many of you know me, many of you don't know me. So I'm the broker owner of Infinity Investments, and we are a commercial real estate brokerage and investment firm based here in Oakland, California. Started the company in November 2009. And here we are, right? November 2009 was a very interesting time to start a company, especially a real estate company. And those times, kind of reminded me now of these times. A little bit different though. You could go back out, you could go outside and go to a restaurant, grab a bite to eat, grab a drink, have a good time. So that's the biggest difference. And now, the whole economy, the whole sectors of the economy are affected. And it's not just, the real estate and financial market. So it is a big difference. But nonetheless, November 2009 was a time of adversity. And that's when we got started. And so I just wanted to make sure I put that out to you guys that, during times of adversity, during times of stress, that can be an excellent time to start a business, to start a venture, to start investing, to step outside of your current reality and maybe rebuild yourself. And that's a big message that I've been really stressing and wanting to get forward to people. So just wanted to talk to y'all a little bit about that. And a little bit more about me is I'm also the past president of California Association of Real Estate Brokers, which is called KRAB. Also the past president of the Associated Real Property Brokers, which is ARPB. Those boards are, KRAB is the state board, ARPB is the local Oakland board of National Association of Real Estate Brokers, NARAB. And if you're a member of NARAB, you are a realtist. I am a realtist. And back in the day, Blacks and other minorities were not able to join the Realtors Association. So in 1947, we formed the Realtists as a way for having a professional trade association for Blacks in real estate and standing for democracy and housing. So I had the honor to serve as California State President in 2017 and 18, and Oakland President ARPB 15 and 16. I also was the past president of NorCal CCIM. which is the Northern California chapter of the CCIM Institute. CCIM stands for Certified Commercial Investment Member. It is a great, the highest designation in the commercial real estate field, but more than the designation, it is a network. It is a network of people in the commercial real estate field and industry that are, you know, producing education in commercial real estate really at the highest level. So so I had the honor of serving that in 2018. All that means is I was connected with people. We did a lot of business. We learned some stuff and we had a great time, which I think is important. And I learned a lot about leadership. So our firm, we specialize in brokerage and investment, syndications, acquisitions of small to mid-sized apartment buildings. And so for most of what we're going to be talking about today, we're going to be focused on small to mid-sized apartment buildings. That's our specialty. We do sell other commercial real estate and residential investments, but the core and the focus is apartment buildings. And we're going to be talking about doing it, investing out of your area. Okay. But just before I go into that, I just want to let you know that in real estate is broken up into multiple different food groups, multiple different markets. The question I always get is, how is the market? And the immediate response, and if you're a real estate professional and if somebody asks you that, you just start blabbing off into your market and stats and figures, you miss the point, because the question says, everybody says, how's the market? The immediate question is, well, what market are you referring to? Is that single family homes? Is that multifamily? Is that office? Is that retail, industrial? There's multiple different markets and they are all very different. Okay, so what we're talking about is apartment buildings, small to mid-sized apartment buildings. Okay, that being said, let's jump into it, y'all. Out-of-state investing. Okay, so here's what we're going to cover today. We're looking through the lens of a California real estate investor. Now, because California is very expensive, we are online, so I know other people are logging in from across the country. If you're in the East Coast, if you're in an expensive market, basically, a lot of people have begun to look outside of their market, especially when they sell a property, to go exchange and buy another one because it's so expensive. So if you're in California, really anywhere in the state, if you're in New York, DC, Miami, parts of Chicago, Seattle, high price markets. So we're looking at this presentation through the lens of that capacity, all right? So then we're going to talk about why go through the hassle of investing out of state. We're talking about the challenges of California apartment market, particularly the prices, the laws, the operational challenges. We're going to talk about the cash flow model, which is something if you listen to my presentation, something I always talk about. I don't miss it, but I'm going to skim over that because we're going to talk more about out-of-state deals. But I'm also going to tell you about the hazards, the challenges, and the benefits of investing out of state. But I always like to give pros and cons. I believe investing out of state can be a great thing, but also a lot of investors that I know, very successful investors, they don't go outside their backyard. Okay, different strokes for different folks. But there's also some hazards to when you invest out of state. We'll talk about that. And then we'll just talk about making sure you do some of the things, some of the keys to success that other investors have employed to make sure that they're successful investing out of state. And I think now, today, more than ever, because we're operating businesses virtually, that's become the norm, that you can do this out of state, and there's some standard operating procedures that'll help you out in doing that. All right. Okay. Now let's talk about California, the Golden State. It's expensive, y'all. It's very expensive. It's always been expensive. Well, relatively. When the market crashed in 2009, 2010, 11, it was a great time to buy apartment buildings. However, right now, cap rates, and that's capitalization rates, and we'll get into that, average between 4 and 5% across the board, pretty much from Sacramento, Bay Area, LA, and San Diego, all the metro areas. And in fact, in cities like San Francisco, parts of LA, San Jose, cap rates are in the 3%. So that's a very low rate of return. All right, and even in the Central Valley, in Stockton, Modesto, all the way down to Fresno and Bakersfield, if you see a 6% cap rate, you're lucky. Now, I do think that'll change over the next year or so, but right now, that's kind of what you're seeing. Price per units are averaging well over $200,000 per unit. Most of the major markets. Okay, that's expensive. Even if you're getting $1,000 or $1,500 a month per rent, but you're paying over $200,000 per unit, the price per unit and the rent per unit ratio is not so, it's not great. All right. So that's a big part of the challenges that we have here in California. Also, a big part of that is barriers to construction have created a severe lack of housing inventory, okay, which really has helped to cause major rent spikes because there's so many people, so many jobs, economy has been rolling. Um, there's just, and people are moving to major cities in droves. People want to live uh, close to where their jobs are. And so what's happening is, like in Oakland, for instance, there's more people moving in than there is available units, and the construction was not keeping up with the inflow of people. So existing rents really from 2010 to 2020 doubled in Oakland and maybe tripled in some neighborhoods, literally. Okay, and we in a rent control city. It's been rent control here. All right. But there's not been a lot of construction. Now you see a lot of construction, but the construction always lags the demand, right? Especially in California, because the cost to build here is much more expensive than pretty much, I wouldn't say anywhere else. I don't know everywhere else, but it's very expensive. You have to do a lot of things to build. So you can't just come and buy some land and just throw up 200 units. You got to know what you're doing. You got to know how to go through that process. So, so here we are. However, it's a silver lining to that. When a lot of apartments do get built and they come onto the market, they do kind of cool the rental market. And so a couple years ago, really downtown San Francisco, actually the rents, cooled off a little bit, because they had so many units hit at the same time, which actually is great because that can relieve some of the pressure. But it softened rental market just a little bit. And now, with the pandemic and everything, it's an interesting time. We'll see how coming out of this San Francisco rental market does, but it's still high demand. All right. The demand is way beyond the existing product type. And that's the thing I want to talk about, which is what makes these prices so outrageous in California. Now, we're just talking about economics and business. Now we're going to talk about the legal aspects of it, man, and it's crazy. So we have existing rent controls in cities like Oakland, San Francisco, Berkeley, and LA. There's been rent control. Now, however, a lot more cities, such as like Richmond in the Bay Area, now they have their own city rent control. However, I just put down here that there's now an element of statewide rent control that just went into effect last year. Forget the AB number, but it's a bill. Interestingly enough, when it was put out to the voters in the state of California, the voters knocked it down, but the legislators passed it, and we now have rent control throughout the entire state of California. The state element of rent control is different from the cities. If your city, like Oakland, you already had existing rent control, then you go by the existing rent control. But in a city like, let's say, Stockton, or let's say down south, Bakersfield, well, they didn't have rent control before, but now they do. But they have the statewide element of rent control, which is much more lenient, by the way, than the local, like Oakland and San Francisco and Berkeley. So, but there is an element of rent control throughout the entire state of California now. All right, and there's in Oakland and I'm going to talk about the town. That's my home. That's where I'm at. We're gonna drill into Oakland a lot. But in terms of, each city and each jurisdiction has their own laws, and they're changing like by the month, man. In Oakland, particularly, in other cities. So this is creating. Oh, also, let me not forget excessive business tax and fees on landlords and parcel taxes. And we pay a lot of taxes in California, right? And particularly for businesses and parcels. So this is, it just makes it tough. And I'm not saying don't invest in California. This is one of the better places to invest, especially when you can time it right. If you bought, like, for instance, 2014, 2011, 2012, excellent period of time to have bought. Okay, if you're buying in 2020, it's a little tougher. You understand? But if you own and you're trying to figure out what to do, a lot of people are selling and rolling out of state. And I'm dealing with a building right now for a client, 17 units. We're going into contract, and we're going to be exchanging out of state. And we'll talk about some of the markets that we're looking into. So I think that's what's driving this thing. I think that's what's going to make a lot of people say, ah, man, I want to, roll out of state. When I got into business, 2003, my first deal was out of state because a lot of investors were looking out of state. That was popular that back then, because it was just so expensive out here, and people were looking for cash flow, and it wasn't out here. When the market crashed in 08, 09, you could buy properties for 40, 50, 20, 30, 60,000 per unit in Oakland, and get $1,000, $1,500 a month per unit. So the numbers made a lot of sense. All right. So that the out of state buying really died off until last couple of years. Last couple of years, it's picked back up again. Okay. And I think we'll see even more as the rental laws continue to get tighter and tougher. I think we'll see more people rolling out here. All right. So let's talk about some of the benefits. Why would you go across the country, or out of your state or out of your area? Let me just also say this. You may stay within the state. Give you an example. You have a property in the Bay Area, you sell it, and you're saying, I want to get out of Oakland or San Francisco, but I love this state. I want to be able to drive my property. Well, you could look into investing into the Central Valley, like a Stockton, Modesto, Bakersfield, Fresno, which I think could be a very viable option. And a lot of people say, well, the Central Valley took it on the chin last market cycle, and they did. But last market cycle, there was a lot of false growth. There was a lot of funny money out there. People from the Bay Area, LA areas were moving in the inland kind of Central Valley type areas because it was cheaper. But there was no real drivers to the economy out there, and a lot of people were overpaying for properties, so the prices crashed. And everywhere they crashed, but in the Central Valley, it was hit hard. I think this time around, we've seen organic, real growth in the Central Valley. You've seen, like, for instance, in Stockton, Amazon set up a distribution hub out there with 3,000 jobs. The city, after they came through their bankruptcy, they're investing into the port, into their infrastructure. So there's actually, and then, with all this pandemic, there's a lot of people saying that, hey, we have to expand our agriculture industry in our own states, because we can't depend on buying produce from South America when say we have another pandemic again, and that produce has a problem getting into the country, when we have some of the most fertile land in the world here in California. And I would think the same thing is for every state is probably thinking about how they can be more sustainable. So I think the Central Valley is another place in certain cities like Stockton will be great places to invest. So when we're saying out of the state, we're also saying out of the area, because even if you invest, let's say in the Central Valley, and you live in the Bay or LA or San Diego, that's still not your, hey, let me just drive 15 minutes to go and take a look at that property. It may be a whole day trip. So you do need to figure out how to operate virtually. Just want to say that. Now, the reason you would do this whole thing about investing out your area is because bottom line is you can get a better price per unit, and not just a better price per unit, but really a better ratio of the price per unit versus the rent per unit. Okay. When I say price per unit, we're talking about a property that sells at 200,000 per unit or 300,000 per unit or something to that effect. If that's the case, and let's say something's 200,000 per unit and you're getting 11,000 or 1,100 a month for rent, it's going to be tough to cash flow that. However, you may be looking at something out of the area that in your market was 200,000 per unit, but maybe that market is 50,000 per unit, and the rent's going to be lower, right? But maybe it's 50,000 per unit, but you can lease that apartment out for $500 to $600 per month per unit. Okay, a much better ratio to the price per unit and the rent per unit. All right. Also, rental laws are usually, in other states, that is, in favor of the landlord, depending on where you are. But most other states are landlord friendly. California, East Coast type states, coastal states are going to be tenant friendly in terms of the laws in general. Okay. For instance, you're going to evict somebody out here in the Bay. You better buckle up because it's going to cost, anywhere from $1,500, $3,000, $4,000, and it can take anywhere from 60 to 90 to 120 days or more. If you make a mistake, you think you're going to try to evict somebody on your own without an attorney that knows what they're doing, you could be in for months of no payment from the tenant and then get your case denied in the courts. However, You go to Texas, let's say, and you buy something. I got a bunch of my friends and realtors out in H-Town in Houston. If you can get somebody out in 30, 45 days. Now, pandemic era, I think a lot of states, there's no evictions right now. So just keep that with a grain of salt. We are going to get out of what I'm calling is a grace period right now. A lot of landlords are not able to evict. A lot of mortgage companies are not able to foreclose. So we're in a grace period. When the grace period is over, then evictions will start back. And just understand, if you're trying to get rid of somebody here for non-payment of rent, you're gonna have a much more difficult time than out of the area. Also, even if within the state, you're gonna have a more it's gonna be easier to evict in a stock than it is in a open. Okay, so that's one of the reasons that you might want to look out that way. Much higher cap rates as well, and cash on cash returns, so you get a higher yield from an income standpoint on your dollar. Okay, and there's usually a lot less competition than there is here in California. There's just more people. It's like 40 something million people in California, and so it's a lot of people. It's a lot of money. So it's competitive. And you're looking at properties, it's you gotta, even when the market was bad, right? Back in the day, 09, 2010, 11, we were hunting and searching for deals, us that were out there making deals happen. But if you found a good deal, even if it wasn't on the market, or if it was with a bank and maybe they hadn't marketed yet, somebody else was tracking it, because that's what we were doing. And so but once it hits the market, even though the price was low, sometimes properties will get multiple offers because there's so many people with so much money. So when you go out of state, a lot of times, just in general, there's less buyers and less money. Okay, and oftentimes you're competing with other people from California. So, but that's why another reason why we love to go out there. Another thing to think about, a lot of sellers are more readily acceptable to carrying financing, which I think in this post-pandemic, or what I'm calling a COVID-19 virtual economy, when we get out of this or going forward, I think more sellers across the country will be for sure readily acceptable to carrying finance or assisting in the financing or master lease options and stuff like that. And I even think here in California, we'll start seeing that a little bit. Now, tax stuff. Also, the capital gains tax rates are typically lower than California, and some states don't even have state capital gains taxes. Like when you sell a property out here in California and you don't exchange, you're going to have at least the federal capital gains, and I know that I think it's capped out at 21%. So you at least gonna have that 21%, but you have the then California capital gains, which starts at 9%. Starts. Okay, so you sell something in here, the minimum capital gains you're looking at paying is roughly about 30%. Now check with your CPA on that. I'm not an expert, but roughly 30%. That means you make $1 million, you're paying 300,000 in taxes. Okay, so another reason why a lot of people are looking, hey, if I can go buy something in Texas or in Tennessee, Nevada, I don't have to worry about all that. So lastly, you can still benefit from appreciation. I'm sorry. Sorry, y'all. I spelled that wrong. I said you can benefit from appreciate, but you can benefit from appreciation in other states. Maybe not as rapidly as you can in California, but you can always find ways to increase your net operating income and thus increasing the value. And that's a big part of what we as apartment building owners, investors, and brokers are looking for when we're looking for properties is properties that have a way where you can increase the value. There's a value add proposition to it. Okay, that's how you can get appreciation when you're going to markets that are typically not going to roll like it does out here. That's the biggest thing people got to get used to. When you invest in other states, typically you're not going to see huge price swings like we do here. That's just the nature of the beast. You're getting more cash flow. So people who are looking for cash flow are those who are a lot of times the ones going out of state. Some investors, they're saying, hey, I got cash flow. I'm looking for huge growth. That's why I buy properties at 3% cap rates in San Francisco, because I'm going to own them for 20 to 30 years. And if I own them for 20, 30 years, I know the price is going to triple. But a lot of people are saying, you know what, that price tripling is cool, but I need some income. I'm investing for income. That's why we roll out of state. But you still can find ways to increase the value by internally increasing your net operating income. All right. Challenges to investing out of state. I told you I'm gonna keep it real with y'all. It's not all peaches and cream for sure. All right. Number one issue. Number one issue, and not just out of state. I think this is the number one issue with real estate investing in general is property management. All right, and getting a good property manager. I'll say in the slides, hiring a really good property manager, because this is the thing. And in the property management industry, for whatever reason, a lot of industries, there's only only the people at the top performers are doing great, or great people that you want to work with. But for whatever reason, in property management, it is even harder to find really good, professionals. So when you're going out of state, one of the things I suggest, and you can do this virtually, it's always great to be there, but if you can't, you can't. But you can research and look for property managers who have what's called the CPM designation. It's another designation that's issued by IREM, Institute of Real Estate Management, a high designation. That's somebody who, really has mastered their craft, got this designation, took the time to educate themselves, and had to show that they did a certain amount of business in the field. And so a great way to go to that market and look up property managers who are CPMs and spend some time. Don't just pick the first one. Spend some time asking them about their philosophy, asking them about the way they manage properties, asking them about, the marketplace, see how knowledgeable they are, look at their systems, see how they operate, how do they report, maybe go check and see their reviews, maybe look into a couple of the buildings that they're managing now. How do they market the vacancies? All those types of things. The same thing you would do in your own market. The difference is you can't go physically sit down and meet them, but you can set up a Zoom call. Are we all doing a million Zoom calls right now? And the importance of a Zoom call versus a regular phone call is that you could see someone, you could see their body language, how they react to the questions you ask them, how energetic they are when you talk to them. Those are all the keys. Those are keys when you to pick up on when you're talking to people and when you're evaluating them. So that's why, but you can do it via Zoom. And that's why I'm talking about the virtual economy right now, because we're doing this anyway. And in every industry, this is what we're doing. We are not just stopping business because we can't go outside. We are figuring out, now some people is kicking back and watching the Tiger Man on Netflix all day long. But a lot of us entrepreneurs and you guys out there who are shaking and moving every day, we're figuring out technology and how to operate. So all I'm saying to you is this is something that you can do in the real estate investing world. Use the same philosophy and tools and technologies and just apply it to real estate, particularly when you're looking into your property managers. But also coordinating with contractors and subs for any major renovation projects that need to be performed can be difficult, but it can be done. I've renovated a 24 unit building and a 58 unit building in Columbus, Ohio, with partners that we did completely from out here in California. We hired a general, we hired subs, we operated on what's called construction control accounts. Anytime you get a rehab loan or a renovation loan, lender's going to make you operate from a construction control account anyway. That way you just don't give all the money to the contractor and he rolls out to Vegas whenever Vegas opens back up, right? You do it in draws. And some of the construction control and some of the draw schedules require the contractor to put up the money for the first draw, and then they get reimbursed. So there's ways, again, of dealing with this. Now, video. So if let's say you hire a property manager, then you hire a contractor to do it. You tell your property manager, your job is to check on that contractor. And then how you're going to check on it? Go by the job site, take a video every week. Let's see the progress, and maybe we hop on a Zoom call with the contractor and property manager, make sure things is going right. Okay, a couple of ideas. Use the technology. All right. Now, the other thing you don't have to deal with is dealing with the perception that Californians are made of money and having an unlimited supply of funds. This is a problem because they think you from California, you made of gold, or they resent you from California, or you're from New York, and they want to stick it to you. And they want, the regular price for something they charge might be $1,000. They're going to charge you $1,500. I've seen this a million times. Okay, so you really got to fight and defend against that, and make sure that you let people know, hey, I'm a business person. I'm coming from this state. The reason I'm coming out here is because it's too expensive back home. So I'm really needing to make sure that every dollar I invest is productive, and you need to keep that posture. And you got to negotiate, right? In real estate and all in business, we negotiate, you guys. It's a lost art, by the way, in real estate, especially the last few years. But it is something that you need to do, and you need to do, not trying to cutthroat people and not pay them fairly, but make sure that you're not being taken advantage of. All right. I'm gonna take a look at the chats. I know. Okay, and I'm a touch back base. I'm gonna come back to the chats. I just wanted to check in because I've seen a few of y'all tapping in. So at the end, I'll come to the chats and we'll chop it up. But I see as we're talking, is this, I'm hitting a couple chords with y'all, so that's good. But now, here's something that I think is probably even a bigger challenge, y'all. Finding good deals that are not on the market, all right? A lot of times the best deals, well, not a lot of times, almost all the time, most of the time, the best deals are not on the market. And we're talking apartments, that market's going to be LoopNet and CoStar. Now there's a site called Crexy that's really making some noise. But a lot of your best deals are not going to be found that way. They're going to be found off market through, relationships. So it's hard. That's probably the biggest thing that we have a challenge with and doing in other areas. Okay, because you need to do, and I'll talk about developing your team. You need to have a team of people that are working the streets out there, like brokers that are active, that call you when they come across a deal. Because let me just say, in the way it works in apartments, a lot of sellers, as we as brokers, we talk to sellers, a lot of them say stuff like this: hey, I'm willing to sell if you can get me X price, but I don't want to put my property on the market. So it's not going to be listed. But as you're out there talking to buyers, know that if you can get me X price on this deal, I'm a seller. They say that to you all the time. So as a broker, if you got buyers, you need to have some buyers, right? And you need to have some sellers, or you're not going to be able to broker stuff. You always have a few sellers that are saying, hey, man, if you can get me X price, let's do a deal. Maybe we're not going to list it with you, but if this is what I want. And then as you have a buyer, or you are that buyer, and you're connected with that broker, you can say, hey, here's what I'm looking for. If you come across something like that, please call me immediately, right? So you need to have, that's difficult to do out of state. However, again, technology, a great site to meet people and brokers is LinkedIn. Go on LinkedIn, look in, maybe search a certain area, look for top brokers. Another way, go to LoopNet. Okay, and look for the listings in a particular area. What you're looking for, not necessarily is the listing, although you want to pay attention to that. You're looking for who's the dominant players in that space. Who's somebody who got 3 or 4 apartment buildings listed. Call them up and say, hey, I was looking at this one deal, and if you don't like it, that deal's not for me, but I just wanted to let you know, I'm out here in California, I'm looking about buying in your area. If you come across a deal that fits my criteria, let me know, okay? You can go on LoopNet, figure that out. That's online. You can go on LinkedIn, look up, apartment brokers in whatever your area is, and you can find other ways to tap in and to network with these guys, because your best deals are not going to come from LoopNet and the other marketplaces, okay? The last thing, challenges, regularly flying back and forth to check on your properties. I know right now it's cheap to fly. That may change. I don't know with the airline industry how that all is going to work out. You do want to check on your properties. It was advised to me, if you're doing big apartments, you have multiple buildings, go out there once a quarter. Now that's a lot. Honestly, it's a lot. I think if you now are using some of these virtual tools that we have, and you're really dialed into it on a regular basis, you can probably get out there twice a year. But you got to really stay on top of stuff, okay? Because it was advised to me, hey, you need to get out there once a quarter, when we were doing a lot of deals in Ohio, per se. But, okay, again, if let's say you own a chain of, sandwich stores across the country, you're not going to go to every sandwich store once a quarter. The CEO don't do that, all right? But they have systems in place to operate their business. That's what we're talking about, all right? That's important. So here's some of the keys to success. I think, like we just talked about, you need to find great brokers to help you identify great deals. not just good regular deals, but great deals. And you have to do what I just was telling you. You have to reach out to them, find who has the listings, let them know, and maybe they have a listing you like, so you can have that conversation with them. But then what you're doing is saying, put me on your list of buyers. Here's my particular criteria. Let's do a deal. By the way, out-of-state brokers love California buyers because they typically, you know, have the perception that we made of money. Okay, so if you're doing an exchange, the numbers, the price points that you're doing, and you're going to be buying, or if you're going to be just if it's a regular acquisition, those are high numbers, especially in their market. So they're going to love you. So make sure you reach out to them, but also find exceptional property managers. And a great way to do that. And here's one thing I wanted to say: not just people who are going to manage the building, but people who are going to manage your income. They're going to find ways to increase your cash flow and increase your net operating income. That's key. So when you're hiring them or interviewing them, you want to ask them about their philosophy about real estate, for their philosophy about management. If their philosophy is just collect the money and pay it all, put all the money back into the property, well, you're not going to make income. But if their philosophy is, hey, we want to pay the bills, set a little bit of aside for reserves, and make sure we're finding ways to increase this income, you know that that's somebody who is going to be kind of like a business partner. Because here's the deal: they get paid more the more income they bring in, gross income. A lot of property managers get paid on the gross income. So, but you want somebody looking at managing the net income because they're going to bring in money and then be wise with the expenses, because your money come from the net, not the gross. Their money comes from the gross. Your money comes from the net, okay? Then what you need to do is this, y'all. Look for a market that has positive job and population growth. Now, we're in this pandemic right now. It's a difficult period of time. It's 30 something million people have filed for unemployment right now. It's tough, right? So we're in a unique period of time, but you got to do some historical research. You're looking for positive job and you're looking for positive population growth, because you won't want to just invest somewhere because it's cheap, y'all. Okay. And cheap, by the way, is a relative word. We may be looking at prices saying our prices are 200,000 per unit. Their prices are 50,000 a unit. Oh, it's cheap. It's a good deal. But that 50,000 unit might be on the high side. If their average market is 40,000 per unit and you're paying 50, well, you just overpaid, right? So you really need to dial into that local market. But the key, what I'm saying here is buy into a market that have positive job growth or positive population growth. A couple of areas we're looking into for clients. Reno, Nevada area. Tesla is big up there. Okay, they've seen a lot of job and population growth over the last few years. Prices are kind of high though. We're also looking into Memphis, Tennessee, Kansas City, Missouri, and Houston, Texas. Memphis, Tennessee is an interesting one because they definitely got some tough neighborhoods. But they have a heavy logistics presence. FedEx is hubbed in Memphis. That's their hub. That's their base. But also Amazon is big in Memphis and has a lot of jobs. And I think those two organizations are going to continue to grow as this virtual economy as we expand in this virtual economy. Okay, looking into Houston, which has a great economy. However, Houston is also very significantly impacted by oil and that oil industry. So I think in the short term, there might be some challenges there. But Houston also has a diverse economy. A lot of technology companies in Houston, a lot of other firms, a lot of financial industries in Houston, a lot of other firms, NASA, Houston, we got a problem. So Houston's a great city, by the way. Great barbecue. And I love their quarterback, Deshaun Watson, my favorite quarterback. So, but it's a great city. A little bit of short-term stress with the oil industry. Now, also Kansas City, Missouri. I don't like their football team, the Kansas City Chiefs, by the way. I'm a Raider, so this was a tough Super Bowl for your boy, right? Raiders, and as a Raider fan, watching your arch enemy, the Chiefs, playing your crosstown rival, the San Francisco 49ers. So it was a tough one for your boy. But I like Kansas City, the rental market. Now, it's also Kansas City, Missouri, Kansas City, Kansas. I'm learning. I didn't know that, by the way. I thought it was always Kansas. But there's two cities kind of in the same. But I like what I see out there. I was looking at a portfolio of properties in the fall, didn't work out, but I like the steady. It's kind of a steady market. It's a strong kind of Midwestern town. and you know, they did just win the Super Bowl. So we're also looking into that. Of those markets, I like Reno and I like Memphis the most right now. Okay, so that's what we're looking actively markets. I told you I was going to tell you what markets we're looking at because I got a client that's in the exchange. I'm looking at with a couple of investors doing some stuff myself out of state, and I want to open up relationships in these markets. So as more of us here in Cali start to say, hey, it's time to roll somewhere else, I want to have connects and deals lined up out in those areas. So those are just 4 areas that I'm looking at. I'll be interested if there's anybody on this call that are looking at other markets. Can you please chat in what markets you're looking into? Oh, one other one is we're looking into New Orleans. One of my agents has a deal that she's working in New Orleans. And so I never looked into New Orleans. I was kind of surprised by how in general the prices are kind of high out there, but you still can find great deals. So those are just some of the markets that we're looking into. What you need to do is, as a system of success, is have a system for managing your managers and your brokers. Okay, so develop that system of operation within yourself, and don't just wake up in the morning and shoot from the hip, but come up with a routine, and that could be a weekly routine. When we were doing a lot of business in Ohio, we used to hop on a call every week and check in with our property managers, with our contractors, because we were doing major rehab. And so we checked in every week. You know, that was a phone call. Now, if I'm doing it, I'm Zooming. And I would want to have the property manager, just show me a quick video of the property, what it looks like. You know what I mean? And just, you know, they may have to get up and sweep up, but you know what that does? That forces them to get up and sweep up and clean up around the property. Okay, same thing with your contractors. Use the video, you guys, as part of your system. And the key, again, just building a strong team outside of brokers and property managers. You need insurance people and that who know that neighborhood, who know that area. By the way, for instance, every area is different. Some areas get flood insurance as standard with their insurance. Most areas do not have flood insurance standard, and you if you get flooded out, like in Houston, for instance, you need to make sure you need to make sure you got the right flood insurance. So you need a local insurance broker, or at least somebody who is familiar with that area. Also, suppliers, vendors, contractors, city contacts. You want to, when you take your trips out there, as you do want to get out there, or as you meet people online, you want to try to meet people who work within the city, planning departments, zoning departments, just to know what's going on. So those are some of the keys to success, some of the markets that we're looking at. This is not a for sure thing. I think it's not going to be for everybody, by the way. If you've invested your whole life and you've had success investing in your backyard, it might be tough. Although I know a lot of people like that who are looking at other ways, are looking out of their area. And so here's just some of the keys to success, because I started my career out of state, you know, and I've done a lot of stuff out of state, had a lot of successes out of state, had some failures out of state. So I can talk for some experience, and I think that we're going to see a lot more of it. All right. But no matter whether you invest at home, no matter whether you invest in your state, you got to do the blocking and tackling. Now, I'm a little bit over my time, so I'm going to blast through this really, really fast. If I say something here that doesn't make sense to you, please be sure to go to my YouTube station, Infinity Investments on YouTube. By the way, subscribe to that so you can stay tapped into us, our content, our updates. But on my station, I have videos that talk about net operating income, cap rate, return on equity, and so forth. So these are just some key indicators that we look at on every deal to see whether it's a good deal or a bad deal. Cash flow, NOI stands for net operating income. The details around that, the price and the cap rate, return on investment versus return on equity, cash on cash return, IRR, and market cycle positioning. Where are we at within any one given, where are we at on the market cycle, on the curve within that particular market, in that city, in that area, okay? Now, I'm gonna go through the cash flow model way faster than I usually do. This is the blocking and tackling of real estate. This is the rebounds. This is the pitching and catching. I don't know what a soccer analogy is, but this is the the fundamentals in soccer that you got to do. It doesn't matter whether it's 100 units, it's a house, it's a hotel. You've got to analyze the income and expense, and it starts with the gross schedule rents. You take away from that vacancy, and you add to it the other income if they have it. That's laundry, vending, and that gets you a number called effective gross income. Now, in order to properly analyze a property, you need to get the rent roll and the last 2 years profit and loss statement from the seller of what they actually paid. That way you can compare what they actually paid or brought in with what you project to bring in. That's very, very important. Okay, so once you got those, the rent roll and the profit and loss statements, you can do a thorough analysis of this. Now, you have to take away from that what's called operating expenses, not your mortgage payment, the cost of doing business. That's your taxes, insurance, management, maintenance, utilities, repairs, reserves. Sometimes there's going to be things like pest control, landscaping. If it's a bigger property, security guards. That's the cost of doing business. Like if you pay cash for a building, you still got to pay all these expenses. So that's the cost of doing business. All right. Now, you take away the operating expenses from the effective gross income and you get net operating income. My bad, y'all. Up here it says net operating expenses. That's just say net operating income. We're making some adjustments. My bad. But it's net operating income, which is the formula for that is the effective gross income minus the operating expenses. Gets you the NOI. In the business, you will hear people refer to this term as NOI, net operating income. Okay. Essentially, it's the net income after accounting for all income sources minus all non-debt service expenses. Basically, it's what's left after you collect the rents and pay your bills, but before you pay your mortgage. In fact, this is the money you use to pay your mortgage. Okay, and this is the value of the property. Remember, earlier in the presentation, I said you can increase a property's value by increasing its net operating income. Okay, that's how you can go to a market out of state that doesn't typically see a lot of appreciation, and you can within that property like increase the occupancy, decrease some of the expenses, increase that net operating income, and you've intrinsically increased the value of the property outside of the market performance. That's what you can do out of state, out of area, in your own market to increase the value of apartment buildings. That's why we love apartment buildings and commercial real estate. All right. Now we come up with a value by capitalizing the income. And basically that means we have to apply the cap rate to the net operating income. The cap rate is called the capitalization rate, which is a rate of return generated by a real estate investment property based on the annual net operating income that a property generates. Basically, it represents the percentage return you would get from a building if you paid cash and didn't have a mortgage. Okay, the formula is cap rate equals net operating income divided by purchase price. Okay, that's the formula. Let me give you an example. Okay, if a building generates a net operating income of $100,000 and the purchase price for that property is $1 million, right? The cap rate would be 100,000 divided by a million, and that would equal 10%. Okay, here's the rule of thumb. The higher the better when you buy, the lower the better when you sell. Okay, it's inverse to the stock market, right? The higher the better because this is your element of return. So you want higher returns. And when you sell it, you want to time it. Again, we talked about market cycle timing. When you sell, you want to make sure that the market investors in general are willing to take less of a return on their investment. So that way, you can make a bigger profit when you sell. That's why you got to kind of time the market. You can't control the market. You can time it though. All right. That's a key piece. Now, other terms that are important, net cash flow. That is including a mortgage payment because net cash flow is simply the cash remaining after you pay all expenses and the mortgage is paid. That's net cash flow. That's the money you can put in your pocket or you can pay some taxes with. The cash on cash return, the element of return or ROI is the net cash flow divided by the total cash invested. Okay, total cash invested, by the way, is your down payment plus your closing costs. Because that's real money you got to put down. Okay, internal rate of return, this is more of an institutional measure, but it's the total return on an initial investment calculated on an annual basis once the property is sold. But I won't get into this too much. Again, I got videos that break this down, but understand the IRR, as it's known in the business, internal rate of return, factors not only the cash flow, but what makes real estate the best investment is you get cash flow, but every time you make a mortgage payment, you're paying down the principal. So that's an element of return. Hopefully the property is going up in value. It might go down. So up or down, depreciation or depreciation, that's an element of return. And the tax benefit or liability is an element of return. And so the IRR takes all those factors into account over a period of time and gives you a return. So those are some key measures that we look at. IRR is more for the bigger properties and institutional people. I want y'all to understand what that is, at least basically. and use these indicators to help you to evaluate properties. Don't just look at a property and say it's 50,000 a unit. Ooh, that's cheap. Let's hop on it. You look at a market that has positive job growth. You look at a market that you can find some top producing brokers and property managers, and then you use these indicators: the net operating income, the cash flow, the cap rate, cash on cash return, to see if that deal is a good deal. Now, oh, and then this is just an example of how we calculate cash on cash. Annual net cash flow divided by the initial investment. So if you bought a property and it made $15,000 a year and you put $100,000 down, this would have been something back in the day. You could have bought this in Oakland in 2012, 11, 13, by the way. Your cash on cash return would be 15%. Okay, 15,000 divided by 100,000. Now, I say ideally, when you're investing in real estate, you want to get double-digit cash on cash return. In the Bay Area right now, you're looking at like 5 to 7%. Central Valley, probably like 8, maybe 10%. Okay, which is why people are going out of state. All right, because you can get higher cash on cash returns. Now, there's an element called return on equity, and I'll wrap with this as we're a little bit over, and I will go a little bit over to answer your questions. But this is where you need to. A lot of people I'm talking to, particularly, maybe have properties in California, and they're figuring out, I want to sell and exchange out of state. Okay, so if you have property now, this is a measure for you, an indicator for you: return on equity. That's the annual net cash flow divided not by the initial investment, but by the property's net equity. Okay, the value of the property minus the loan, the debt against it. Okay, and the cost of a sales transaction. That's going to give you net equity. So the formula for that is you take $15,000, your an annual cash flow in the previous example, and divide it now by the property's net equity. Let's say in the previous example, you bought a property with 100 grand down, it was making you 15, but then that property increased in value like we've seen over the last few years. So that $100,000 of cash turned down into 300,000 of equity. So you do this, you run this equation to figure out what's your ROE. Your return on equity is 15,000 in net cash flow divided by the 300,000. That's 5%. Okay, you was making 15% on your cash, but you're only making 5% on your equity. So you're maybe thinking about rolling out of state. With ROE, remember, it diminishes as the property appreciates in value. So that is when your property goes up in value, you want to evaluate, hey, can I take this bigger bump I got now on my cash, that because now my equity is doubled or tripled or it's grown, can I take that equity and reinvest it and do better? And here's just an example of why you might want to invest out of state. Okay, so we gave you the example of a return on investment of $100,000 earning you 15%. Then the property grew in value, and so at 100,000 turned to 300 of equity, right? Which has been a real world example, even better than this over the last 5 years. So you're only making 5% on your equity. And you say, hey, I want to take this 15,000 though, and I want to expand it. I'm tired of these rent control laws. The tenants are stressing me out. So we look at it, and you come to a broker like me, and we list the property, and we do a 1031 exchange. Now, again, I have other videos that break down 1031 exchanges. It's a way of selling property and deferring the capital gains that you'd have to pay, as long as you follow the rules associated and you reinvest those funds. And if you do so, you don't have to pay the capital gains taxes. So you would do an exchange, and you would take that 300,000, put towards a note property. Now, here's the deal. Because an exchanges are time sensitive, you're going to have to invest. You're going to have to find a property within 45 days from the time you close escrow. So that means when you sell in a hot market, you kind of got to buy in a hot market too. Another reason why buying out of your area and buying out of your state can be very profitable, because you can sell a property here in the Bay Area where it's hot like fire, and go out to maybe Memphis where it's not as hot, or another market that you like, and increase your returns. And so, but it's still, let's say like now, the market's higher than it was in 2009. So you let's just say you went out and you bought a property, and when you brought this property up here 5 years ago, you were making 15% on your cash. That 300,000 of equity turned into cash because we did the tax deferred exchange. Now you got 300 of cash, not in your pocket, in the 1031 exchange account that you then reinvest. And if you were to reinvest that and only make 10% cash on cash return, remember, if you're going to go out of state, by the way, you need to make at least 10%. And in some areas, you need to make more. Don't go out of state and make less than that. That you just defeated the purpose. You might as well stayed here. If you go out of state, you have to have a minimum return that makes some sense. I'm telling you, it needs to at least be 10%. Because if you can do that, you have taken your 15,000 you was making here and turned it into 30,000 a year there. You doubled your cash flow in a single move. Okay. That's the power of doing this, guys. That's the power of taking your property in the Bay Area and buying a property in Stockton, or taking your property in LA and buying a property in Reno. Okay. That's what you can be done. Follow the keys to success that I just talked about, and you can be successful. Again, different strokes for different folks. It's not going to work for everybody, but y'all listening and tapping in this for a reason. So follow some of the standard operating procedures to be successful in this process, and do what you need to do to build your investing portfolio. Okay. I went a little bit over, but I needed to bust that down for you guys. I'm going to take more time to answer some of these questions. Okay. I'm going to stop my share and I'm going to pull up I know we got 4 questions. I'm going to go to the questions and then to the chats. Okay. So Gwendolyn Woods, you asked, can you please share this PowerPoint following the webinar? I absolutely can, Gwendolyn. Make sure you send me your email address. Everybody who registered for the webinar, by the way, we will send out the slides and a link with the video of this webinar that we will be putting on YouTube. So Gwendolyn, absolutely, we will be answering that. So hopefully you heard that, Gwendolyn. We will be sending out the slides. Next one is Alan Adanagao. Is there a good property management company that operates nationally? Well, I'm sure there are. And the issue with that is that they would have to be licensed in each state. That's an excellent question. That makes me want to look into that. I don't know one off the top of my head. Every market that I'm looking at the local players. A lot of bigger firms, like for instance, give you an example, CBRE is a big broker. They manage not apartment buildings, but they manage and broker office buildings across the world. So typically somebody that's going to do that nationwide, they're a bigger company. Okay. So Alan, I hope that answers your question. Also, you followed up with Alan Adenagao, with the NOI and property value being affected by the cap rate, how can you figure out the market cap rate yourself? I've seen a lot of conflicting numbers in the same submarket, and it makes you be dependent on a broker's presentation, which may vary. And excellent question, Alan. What you want to do is you want to go to the Institute of Real Estate Management. I don't know their website off the top of my head, but just Google Institute of Real Estate Management. It's called IREM. They produce quarterly reports with market cap rates on each market and submarket of the major MSAs across the country. And I think you should be investing in a major MSA, in at least that area. And if you go to IREM, you can get all those details broken down where it's real numbers, not necessarily dependent on the brokers. Like what you just said, brokers can be exceedingly positive, so you know what I mean? That's kind of in our nature, right? That's what we do. So check IREM for the real numbers on cap rates, vacancy rates, price per units in your market, in the market MSA that you're looking at. And that's both for commercial and residential, Alan. Thank you. Dietrich Harris, do you have broker referral partners out of state? Yes, we do. I work, like I mentioned, with 2 big real estate networks. First of all, the Realtors organization, and then also CCIM. These are national organizations. So I was involved in the leadership of both organizations. I go to all the conferences, so I know people all across the country. Each one of the markets that I'm looking into, I know someone who operates in that area. And then like we always look to do is we look to develop and further relationships and do networking. But Dietrich, yes, absolutely. And Dietrich, reach out to me and tell me what market you might be looking into particularly, and I can put you in contact with some folks. Okay, so thank you. I see. So hopefully that helps, Dietrich. That was all the questions we had in the question box. Now I'm gonna hit up the chat. Okay. Michael Hill, I've seen where they don't give you the sales price, but give you the NOI and cap rate and work it back, or cap and work it backwards to get to the sales price. Yes, you're right. A lot of times, they won't give you the sales price. They'll just say, hey, it's a 6 cap. It's a 6 cap. We're bringing in, $50,000 a year in net operating income. A lot of times people do that because they want to test you to see if what you got, if you got the juice, if you know what you're talking about. Big part of why knowing the terms are important, because you want to be able to know what you're talking about. In commercial real estate, people gonna always test you out, man. They're gonna test you out in residential too, but you want to know the terms. So again, subscribe to my station because I have a lot of videos where I'm breaking down cap rate, internal rate of return, cash on cash, net operating income, and the lingo, because you got to be able to talk the same language too when you're negotiating. And also, like as a broker, when I'm working deals, we're working at a fast pace. So if I'm working with somebody, let's say I list a property and I get multiple offers, and if I'm working with somebody who knows what they're doing, I'm gonna be more inclined to work with them. And I'm a cool, positive cat. A lot of commercial real estate brokers are not. You know, they a-holes, man. Just there's no other way to say it. That's who they are, and they're gonna look and test you to see if they're worth spending their time on you. Okay, so you got to know some of these basic terms and terminology. But great point, Michael Hill. And you can always work it backwards, because if you have 2 or 3 numbers, if you have net operating income or if you have the cap rate, you can solve for the value. If you have the value in net operating income, you can solve for cap rate. If you have 2 of those numbers, you can solve for the third. So, okay. Now we got Lee. And if I'm saying your name wrong, I apologize. Oh, no. Lionel Bohannon, great information. Thank you, LB. I love you out there, boy. I appreciate your support. One of the legends in the game as a realtist. Raymond Noble, can I get your keys to success slide? Okay, yes, Raymond, we're gonna send you the whole presentation, bro. I appreciate that. We will make sure you get that entire presentation. All right, Raymond, I see you negotiate. Yeah, I was weaving and bobbing. Negotiate, but we do have to negotiate on all things. Okay. What other questions do we have? We might have one. There is Michael Hill, another typo on the challenges page inside of throw money. So yeah, made a couple typos on that. Sorry guys, and we'll tighten that up when we send out the slides. Okay. Raymond also asked, have you been dealing with your tenants that are not paying rent? Great question. Okay, right now we're in a period of time where a lot of people are not able to pay rent, right? And you can't evict people. So yes, we're dealing with that on a lot of properties here in Oakland. And the best way to deal with it is, first of all, is to reach out to your tenants to figure out who can pay, who can't pay, and to work through it with them. Don't just kind of come down on the hammer. First of all, you can't come down with the hammer on them right now. So it's better off as a strategy to build a working relationship, but also let the tenants know that there's going to be a time when we're going back to normal, and you're expecting to collect all of that back rent. So now will be a time to collectively talk about a repayment plan versus just hitting them with all the rent at one time and creating a me versus you type of situation. So looking at the chat, Valencia, hey, what's up, Miss Valencia? So you cool, positive cat. I appreciate you too, V. I love Sherry Stith. Thank you, Sherry Stith. Thank you. You said great info. I appreciate that. I appreciate you all, Deetra, for your comment. I really hope you guys continue to tap in. Oh, there's one more new message before we leave. Kidane. Kidane D says, thank you. Thank you, Kidane D. Much love to you. Appreciate it. And you guys, let's stay tapped in. All right. Tell me what you guys are doing. Message me, connect with me on LinkedIn. Subscribe to the YouTube station, y'all. I'm putting out real content in this investment world. And I'm in the pandemic. My business mode, my shift, my pivot is I'm going all in on content. Well, I can't go out and do my seminars like I usually do these seminars, and I love doing seminars because I get to see the people right there in front of me, and then after we get to meet and we get to talk and we get to shake hands. So I can't do all that, y'all. But I'm not sitting back. Like my battle plan is I'm putting this content out, man, because I want people to be sharp, focused, motivated, dialed into real education so that we can go do some business. I do not think it is a time to rest on your laurels. It's not a time to sit back and say, you might have got a PPP loan or idle loan, or you might have got accepted for unemployment, or you got whatever. And it's not time to sit back and kick back, y'all. It ain't that time. It's time to go all in. You know what I mean? It's time to go all in, because when 30 million people are unemployed like this, and the stimulus package is like three times bigger than the stimulus package that Bush and Obama passed combined, and they probably gonna have to do some more stimulus. Let's not be fooled by the temporary, you know, pleasantries that we may have, right? Like home prices. I read something this morning. Home prices in the Bay Area went up again last month somehow. All right. Don't be fooled by, I got my check, I'm chilling, let's watch this Netflix all day. I'm not hating on Netflix, but I'm just saying now's the time to dig in. Now's the time to take that course that you were thinking about. Now the time to read that book that you were thinking about. Now's the time to maybe you to start making some content and putting it out there. Now's the time for you to start doing research. Now's the time for you to build your team, expand your team. Now's the time for you to sharpen your axe, man. You know, I really mean that from the bottom of my heart. And I want to see us all move forward. And I want to see us lead the charge in this virtual economy. And let's not be left behind, y'all. So with that, I'm going to wrap this up, man. Much love, grace, and peace to you all. And we will be sending out these slides and this YouTube video. And y'all have a great rest of your day and a fantastic rest of your week. And best of success in your real estate investing careers. Peace out, y'all.